So welcome to another video. My name is Robin, and as per usual, I'm joined with this lovely man, Kirill.
Oh my
Yeah,
god,
Kirill
look
is
at him, look at him. Oh, just right in my heart. Oh, thank you very
exactly.
much, guys, sir. Long time no see.
Le- exactly. Let's just disclose that Kirill has some audio issues at the moment because his neighbor decided to start driving his car 24/7 on this day. So therefore, Kirill will be muted throughout most of the video until he's needed. Today, we'll be talking about ASML, close to our hearts from both me and Kirill because it's a Dutch company. It used to be part of Philips, and then later on it got detached. Basically, in a nutshell, they make highly advanced machinery um, in order to make small chips. And they have this technology that no one else knows how to do. And that, yeah, of course, gives them sort of some kind of monopoly position. And yeah, ASML is used often in Dutch geopolitical exercises. Yeah, so that's basically ASML in a nutshell. Chip manufacturer, or at least manufacturer of chip machinery. There we go. They released their earnings and they had a quite steep increase of 70% in January for the stock price, and then also the revenue exploded as well, just like Creel's mind just did. Yeah, Creel, can we just open up the spreadsheet and I'll take that first part from you?
Absolutely, as long as this guy would stop revving his lovely engine, yes. And yes, thank you for the introduction as well. I'm gonna be like, yeah, probably half silent, but as Robin mentioned, is a very interesting company from, let's say, the business perspective, but also because it's Dutch and it was originated from Philips, so this is something which is quite close to us. And yeah, we just want to maybe show a little bit of the Dutchiness to you guys, especially who are not living in the Netherlands. So yes, let's have a look. So we just popped up our lovely spreadsheet, soon to be a web app, and you can see some nice stuff, huh? So the return on invested capital, 50%, even bigger than our previous company in scope, Lockheed Martin, which is very good to
Mhm.
hear. So it means that they got some very good competitive advantage, and as you said, it's very what they're making is highly advanced in terms of the technical aspects, right? UV lithography machines are very hard to make, hard to operate, and it's very hard to get them nowadays as well. And that's why PE ratio is quite high as well, right? So about 50. Yeah, you get a high quality company, but you also have to pay high price for it, right?
Yep, exactly. Yeah, if you have a couple of $1,000 laying around, then for sure this is your starting point.
Yeah.
But yeah, as you said, some good numbers. Um, yeah, they even though they pay out dividend is such small that we can just skip it. Can we just look at the foundation? Yeah,
Mm-hmm.
that's really good. So good revenue growth, net income growth, all green. The long-term debt is covered by the free cash flow, which of course really good to see. And they also buy back shares, which is a good thing because you want the pool of shares outstanding to be smaller. And if they dilute you and produce more shares, the price will increase. Whereas if they buy back shares, the price, of course, will decrease. And it also gives a strong signal to the shareholders that they themselves believe in the company. So it's a good thing to see. And then they have been growing the dividends, but as I mentioned, it's such a small number that this doesn't really bother me at all. Yeah, we can.
But yeah, the only thing is if they're going to be consistently growing their dividends with double digit percentages, that's actually pretty good. Like even if you, for example, start now, yield is only 0.6%, right? But then over years, that's actually gonna substantially increasing year over year. So that's if you just start low and then it's just gonna be expanding so rapidly. That's good to see as well. So
Yeah.
yeah. Moving on.
Ooh, this looks really good as well. So
Mm.
this is exciting. It's been a long time since we have seen so much green consistently in a company. So net earnings
Unless it was
ratio.
American Express or Visa. Speaking of the
True,
devil.
true. Oh, I mean, but for like a tech company, right?
Yeah, true, true. That's
So
good.
their net earnings ratios are really good, above 20%. This is for sure what you want to see. Interest expense ratio very low, 1%, 0%, really good. The R&D costs are, even though they have such advanced machinery, it's below 30%. Like normally you want it to be below 20%, but given the scope of what they produce, I wasn't, yeah, thinking it will be lower than maybe 40% even. But it's good to see that they have it down and that they have a formula and it sells. For the selling and general expense ratio is also around 20. It's a bit on the high side, uh, and I don't know how they would even, for example, market this product, but I believe it will be just, yeah, uh, be very pricey to lump a whole machine to every trade fair on this planet.
It's also quite tricky, right? Because for example, there were some news that nvidia was experiencing very high increase in orders from China before the ban was announced, right? And similar things are also happening probably with ASML. Even though ASML is a Dutch company, it's still, as you mentioned, can be used as a political leverage. So they actually, if they want to grow, they need to find some other, let's say, even countries to sell their products to. Because let's say TSMC, Taiwan Semiconductor, is also, let's say, in quite a shaky position from the geopolitical standpoint. It's hard. It's hard, but that's why probably it's they are keeping them high, because even they when they sell some certain brand new machines, right? Then they also take the old ones back, they refurbish them, and they still
Yeah.
resell them because there's still high demand even on the older versions of these machinery. So
And
yeah,
also, a reason why this, as in the selling in general, might be a bit higher is also because they really can't train people other than their own people to operate these machines and also to maintain them on site. So these people, these maintenance workers, are sent around the globe to maintain these products, and that could be one reason on why this
yeah.
the cost is higher than it usually is.
Yeah. But then it also then yeah, from let's say the expense standpoint, this is not very good. But from the competitive advantage standpoint, that's actually valuable
Yeah,
because
yeah,
you
exactly.
keep
Yeah,
your let's say the secrets in house, and for the other companies it would be hard to replicate what you're doing. So then
yeah,
in this case, they're doing a good job, I would say.
exactly. And also, I don't know if this is true, right? So we need to fact check it maybe, but there was a story that someone got their hands on ASML machine. I think it was the Chinese government. I'm not really sure. And then they did some reverse engineering, but they couldn't put it back together
Yeah,
because
yeah.
it was so complex.
It's not a microwave
Uh,
you're disassembling and putting back
exactly. Yeah.
together. So yeah, that's true.
Yeah. So then also for the depreciation, yeah, probably because they moved these products so quickly,
Yeah.
relatively.
They
Uh,
cannot stockpile them. I mean, it's
mhm.
also probably quite similar situation as Lockheed Martin, like in the description.
Yeah.
But yeah, there's just so much demand and probably not enough supply because they cannot also ramp up the production so quickly. Probably that's also what makes it. It's like like Ferrari, but when it gets to the IT sector, probably you
Yeah.
gotta make very high end machinery, but it's a lot of customized solutions. Probably a lot of manual labor is involved, highly skilled manual labor as well. So
Mhm.
yeah,
Yeah. And then again, we look at the free cash flow growth on average in 5 years, 34%, which is insane.
yeah,
Nice revenue growth of 24%. And then this year, they released their income statements, and then a 30% increase in 2023 is also really good to see, double digits.
yeah.
The net earnings been growing crazy, 34% on average 5 years, and their shares outstanding have been decreasing on average 2%, and also consistently buying back shares year on year. So all in all, really good things to see.
Only thing is maybe just to add up on that, it's good to see that the company buys back its own shares. Sorry. But on the other hand, you also would consider that good if a company buys them back cheap. If they buy them back at the P/E ratio of 50, I would also say like, is that actually reasonable? You know what I mean? But on the other hand, if they just take it as a policy that yeah, we're just gonna buy back maybe like 1-2% every year, regardless, so they don't really have to pay attention to, let's say, the fluctuations of the stock itself. That's
Yeah.
fine. It's fine. But yeah, you can also see that they're not buying back a lot, so it's fine. It's just a little bit of a pocket change, let's say, for them. That's okay.
Yep.
Yeah.
All right, Fundsmith.
Yeah, not a lot to talk about in here, probably because we also chose the ASML stock traded on Nasdaq, because we are traded in different places, so maybe the financial reports could be a little bit different depending on the one you choose. But gross profit margin of about 50%, of course, as we discussed, great. Return on capital employed was also around 50%, great. Cash conversion is also pretty good, so it means their ability to actually get um, the pure cash from all the operations and from the sales of the goods. So they're actually able to perform well here, apart from the last year, which is actually quite questionable. What's the reason behind it? But yeah, that's to be honest, I don't really see any red flags in terms of the company as a business, apart from its complexity and just geopolitical, tensions and stuff. Because if there would be some government or some other body saying that you cannot do business with somebody just because you're not friends with each other, that might have some negative impact on you as a company, and you don't really wanna have these troubles because, well, we're living in the world of capitalism, at least in the Netherlands. So yeah,
Yeah,
that's something to keep in mind.
exactly. All right, so then we'll get into what's it. What is it worth? Is it worth the high price tag, or is that just is the valuation as micro as the chips they produce?
Badum.
There we go. All right,
Good one
so
though, good
again,
one though. Yeah, I liked it. I liked it. Good job, good
thank
job.
you.
Yeah.
Again, two ways of doing this. First option is going to Yahoo Finance,
Yes.
go to ASML,
Mm-hmm.
check for the analysis, check the analysis that the analyst made. So we go all the way down, and we can see they expect for next year growth of 44%, which is high, of course, but then also considering their last years has been growing as well, but 40% might be a bit too high. And they also expect an increase in 23% for the next 5 years, and then every year. So
Because the thing is, it twofold, right? So first of all, we're talking about inflation, right? Which is still a rather question mark in Europe and in US and just globally. And then also just the aspect of the company actually able to sell more of the machinery, right? Or maybe come up with some other new products which could be a little bit more accessible to the other firms, but less maybe advanced. um, we could probably just let's just double check some additional
yeah,
options. So yeah, the other option would be just to check what would be the averages for the free cash flow growth or for the revenue growth for the past years, right? So if, for example, check revenue growth here, we'll just plug it in here. It's about 18%, still very good to
hmm
my taste. And for the free cash flow growth, let's have a look. See, 30%.
yeah. So we can take the average of the two of them, but then again, there's a lot of tensions geopolitically with all the conflicts going on. We don't know what's going to happen even like 2 years from now or 1 year from now. So I think 40%, 30% is already a bit too high. I would downgrade that. So what do you think, Kirill?
You just chose the perfect timing because the guy also calmed down a little bit. But we can maybe do 30%. Let's say just to imagine like a very nice positive world. Everything is fine. As analysts would be right, and then people finally would maybe stop fighting each other, and then ISML would be able to sell its products wherever the company wants. So let's just do 30%, just to
Yeah,
check,
I,
just to check, I would say. Yeah, for
P
P
ratios.
ratio, yeah, let's check what it was in the past years. So we're talking as low as 30 and the highs of 50. So at the moment, it's actually trading at its, well, probably all-time highs when it gets to
Mhm.
the PE. I'm not talking about 2010 because that's a little bit too far away. But probably I would say, to be honest, I would say from the ballpark of like 35 to 60 is rather reasonable for the company, just because of like all of these hype and just very good growth estimates for the future. Yeah, what do
All
you
right.
think?
Yeah, let's do it.
Yeah. Okay. So 35 and 60. Do you want to read your lovely mantra again?
Yes,
One more
yes.
time?
Okay.
Let's
So
go.
for the required rate of return, what we always consider is that when you would buy an index fund or an ETF, you would get between 7 and 10% annual yield. But because you're stock picking, you're having a bit more risk. You also want to receive a payout for that additional risk. So we keep this at 12% because you want to have the little extra. Of course, if you want to have more investing or returns on your investment, or you think there's a lot more risk involved with the investment, you can increase this percentage. Discount rate we always keep them at 12%. And margin of safety is something that yourself can play with. For example, if you're younger, your margin of safety is going to be lower. If you're older, your margin of safety is going to be higher because the losses that you make can be recouped over a long time period when you're younger than, for example, when you're older and you're putting your life savings on the line and it goes down the drain. So you want to have a bit more, stability, let's say. For me personally, I keep this mostly around 20%, but as we will get into it now with the current global situation, we might actually want to increase it a tiny bit, um, to maybe 30-40%. And then for the discount cash flow formula on the amount of years that we want to look into the future, I think with this kind of tools and machinery that's being built, the demand is high, but there's also a lot of tensions around it, and I don't know what's going to happen today or tomorrow. I'm also not really familiar with this industry, but what I gather from the news, for example, is that there's a lot of people trying to replicate this technology, and a lot of people also want this technology to have in their own countries, let's say. So I would definitely flow.
Yeah, true. So shall we then in this case keep it to 5% for the discount cash flow formula for the projections? What do you think?
Yeah,
Yeah.
let's do it.
Okay. Yeah. And then for margin of safety, I guess 30 is alright. Yeah. Okay.
Yeah, exactly. Yeah.
Yeah, and we see actually an interesting point. So if you would assume that you actually understand the business and you would actually rely on these assumptions and you would remove the margin of safety or at least minimize it, it's still an okay price to pay for SML stock, even though it went up almost 50% in the past few months from, let's say, lows of, I think, 600 euros if it would be traded in the Netherlands. So yeah, so the valuation says about 1,100 bucks is okay price to pay. What do you think?
Yeah. Yeah, I didn't expect after, of course, the surge of last month. I didn't expect it to be that good value, but still, there's some wiggle room to be in. Yeah,
Yeah,
some bucks to be had.
yeah, but then again, let's put it like that. The thing is, this is rather just the what the assumptions we put, just based on pretty much zero knowledge about the company, about the
Yeah,
industry, about the specificity of it. So in this case, you just have to again just do your due diligence, not a financial advice, yada yada yada. You guys should know it by now, hopefully. Uh, but yeah, if you would just take the numbers blindly, that's actually not a bad deal.
yeah, agreed. And then where can you get this sheet? I'm not talking about the micro chips, but this beautiful sheet that we have here, soon to be web app. There we go. Oh, amazing.
Yeah, there was again the guy. But if you want to get it, and if I'm gonna just stop talking, you can just continue. But this is our website, 930.com. Link, of course, will be in the description, hopefully. And then the same mantra from my side. It's only $1, €1 at the moment. No additional fees, one-time payment, just because we want to make it easy, accessible for you guys, and you do not, spend a lot of money on these very heavy and expensive and very complicated subscriptions. And if you actually jump on that train now, you're also gonna get all the additional updates, our new web app included in that price. So only €1 for this kind of value. If I were you, I would sign myself up right away. But well, of course, it's all up to you guys.
Exactly. And on that note, we're gonna end the video. So thank you for watching. Like and subscribe if you did. Let us know And if you have any questions or remarks, let us know in the comments. We will try to reply to your comments. And then, Kirill, thank you for being here, even though your neighbor wants to rev his car today. And then we'll see you guys somewhere next week.